Imagine cashing out $400,000 from a property you've owned for 25 years, thinking you're finally free to enjoy retirement, only to realize the government is waiting in the shadows to take a bigger slice than you ever expected. That sudden shock, that pit in your stomach, this is what many seniors face when selling an investment property without fully understanding the tax ripple effect. Could a seemingly simple sale quietly trigger higher taxes, Social Security penalties, or even Medicare surcharges? The answer might scare you, but knowing the mechanics could save you tens of thousands of dollars. Selling a rental property in retirement isn't just about adding a lump sum to your bank account. It's a decision that can echo across your finances in ways that aren't obvious at first glance. You might think, I bought this house for $150,000. It's now worth $400,000. That's a $250,000 profit. Great. But there's more beneath the surface. For one, depreciation. Over 25 years, you've likely depreciated almost the entire value of the property. Depreciation reduces your taxable income each year, but the IRS doesn't let you forget it when you sell. That $250,000 gain isn't pure profit in their eyes. It's partially recaptured as depreciation, taxed at a rate up to 25%. Suddenly, a portion of your easy money is sliced away before you even consider federal capital gains. And it doesn't stop there. The $400,000 windfall is not just a one-off number, it interacts with your other income. Then there's timing. Selling in one lump sum versus spreading the gain over multiple years isn't just a technical detail. It can be the difference between paying a small fraction in taxes and paying tens of thousands more. Even strategies like 1031 exchanges or installment sales can drastically reduce the immediate bite, yet many seniors are never told these options exist. The problem is that the complexity of retirement taxes is rarely intuitive. You think you understand your capital gains, but suddenly Medicare premiums and Social Security taxation appear like hidden traps. One misstep, and that $400,000 could feel more like $300,000 after Uncle Sam gets his cut. So what does this actually look like in real numbers? Imagine your property sells for $400,000. Cost basis $150,000, nearly fully depreciated. Depreciation recapture could cost roughly $62,500 alone. Add long-term capital gains on the remaining profit, say around $45,000, depending on your bracket, and now you're down over $100,000 in federal taxes before even touching state taxes. On top of that, your Social Security taxation could increase, and IRMAA could push your Medicare premiums to the highest tier, adding thousands more each year. Suddenly, that windfall isn't as windfall-y as it first seemed, but it's not just about the numbers on a tax form, it's about lifestyle, choices, and timing. Imagine retiring with dreams of traveling, helping grandkids, or even starting a small business. That $400,000 was supposed to fund freedom, not fund IRS bills or surprise Medicare hikes. That's why planning ahead is crucial. One strategy some retirees use is an installment sale. Instead of receiving all $400,000 at once, you spread the payments over several years. This way, your income in any single year stays lower, potentially keeping you out of higher Social Security taxation brackets and reducing the immediate bite from capital gains taxes. Another approach is a 1031 exchange, which allows you to defer taxes if you reinvest the proceeds into another qualifying property. It's not just a loophole, it's a legal tool designed for investors, but it requires careful planning and adherence to strict timelines. For seniors who want liquidity rather than another property, an installment sale often makes more sense. You don't just reduce taxes, you also manage the impact on Medicare premiums and IRMAA surcharges, which are often overlooked. Small adjustments in timing can make a dramatic difference. For example, selling in a year where other income is unusually low can minimize your provisional income and prevent Social Security from being taxed at the highest levels. And there's the psychological aspect. Many seniors underestimate how a lump sum sale affects their retirement cash flow. It's easy to focus on the gross proceeds, but net income after taxes, premiums, and potential state levies is what actually funds your lifestyle. One common mistake is assuming that Social Security benefits are untouchable or immune to tax spikes. In reality, a large capital gain can temporarily push your benefits into a zone where you pay more taxes and higher Medicare premiums for years. Even if your day-to-day life doesn't change immediately, the cumulative effect can erode the security you've spent decades building. It's also worth considering state taxes. Some states treat capital gains differently, and a sale that triggers minimal federal taxes might still have a significant state liability. For retirees who have lived in low-tax states for decades but own property elsewhere, the combined federal and state impact can be surprising. This is why a holistic view of your finances is essential. You can't look at the sale in isolation. It interacts with every other component of your retirement plan, from investment income to Social Security timing to Medicare costs. Planning isn't just about avoiding taxes, it's about control. Imagine being able to sell your property, maximize your net proceeds, and still keep your Social Security and Medicare costs in check. That's the sweet spot, but hitting it requires understanding the interaction between depreciation, recapture, capital gains, provisional income, and IRMAA calculations. It might sound complex, but once you break it down into step-by-step strategies, the path becomes clear. Knowledge here isn't just power. It puts money in your pocket and peace of mind for your retirement years. The key is to approach the sale with foresight and strategy rather than impulse. Start by calculating your true taxable gain, factoring in depreciation, recapture, and long-term capital gains. Then, layer in your existing income, Social Security benefits, and potential Medicare IRMAA brackets. This combined view allows you to forecast exactly how a $400,000 sale might ripple through your finances over the next several years. It also highlights opportunities for timing adjustments, installment sales, or other tax deferral strategies that can save you tens of thousands. Another critical factor is consulting the right professionals. A CPA familiar with retirement taxation and a financial advisor who understands Social Security and Medicare rules can help you map out the optimal strategy. Many seniors make the mistake of relying solely on generic online calculators or past experience with smaller transactions. The rules change over time, thresholds adjust, and what worked 5 years ago may no longer be optimal. Professional guidance ensures that you're not just guessing, you're making deliberate, informed decisions that protect your wealth and your lifestyle. It's also worth considering the emotional and psychological side of selling a property. This isn't just a financial asset. It may hold memories, represent decades of hard work, and symbolize security. Feeling the weight of taxes and fees can make the decision feel heavier, but planning properly transforms that stress into confidence. When you understand the numbers and the strategies available, you're no longer at the mercy of surprise bills. You're in control, able to make a decision that aligns with both your financial goals and your life goals. Finally, remember that every senior's situation is unique. The $400,000 example illustrates how a large property sale interacts with taxes, Social Security, and Medicare premiums, but your exact numbers will vary. The takeaway isn't just the math. It was the principle. Large gains in retirement need careful planning. A single decision can have cascading effects, influencing taxes, benefits, and long-term financial security. By approaching the sale strategically, you can preserve more of your wealth, reduce unnecessary tax burdens, and maintain the lifestyle you've earned. Selling a rental property in retirement doesn't have to be a financial landmine. With foresight, careful calculation, and the right strategies, you can turn a $400,000 windfall into a true boost for your retirement rather than a source of stress. Understand depreciation, recapture, capital gains, and the interaction with Social Security and Medicare, and consider timing, installment sales, or exchanges to reduce your tax burden. Consult professionals, plan deliberately, and treat the sale as a pivotal moment in your retirement strategy, not just a one-time transaction. When you do this, you preserve not only your wealth, but your peace of mind, ensuring that decades of hard work translate into the retirement you've always envisioned. Selling smart isn't just about the money, it's about freedom, security, and enjoying the life you've earned.